This episode is brought to you by Plaid. Plaid helps lenders approve more creditworthy borrowers without taking on more risk, combining real-time cash flow data with behavioral insights. It's a fast, familiar experience people trust and that actually converts. Learn more at plaid.com/FTT. Hello, and welcome back to the Fintech Takes podcast. Today's episode is a special guest episode, and the guest is extra special. Marc Rubenstein is someone who I've gotten to know through the internet because, like me, he is a newsletter author and a content creator covering the financial services space. His newsletter, Net Interest, is truly one of my absolute favorite, can't miss a single edition newsletters, where he covers a huge range of different topics, everything from investment banking and private equity to mortgage lending to AI to stablecoins and layer one blockchain solutions. He is not afraid of any topic. He's deeply experienced in the space and is a delight to talk to with a British accent to boot. I kind of hate him, to be totally honest. Or I would, at least, if he wasn't so nice and so knowledgeable. Today's episode, we cover a lot of ground. Basically, I just went through his archive from the last year, picked out a bunch of articles that he wrote that I really enjoyed, and grilled him on the topics of those different articles. So we bounce around a lot of different areas, have a lot of fun, and you'll probably hear me furiously scratching out notes as I'm talking to Marc in this recording, because that's just how informative it was. Without further ado, here is Marc Rubenstein, author of Net Interest. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Marc, thanks so much for joining me.
Good to be here, Alex.
It is a delight to have you, sir. I can't believe we haven't done this before. As I said in the intro, am a huge fan of your work and your newsletter. And so it's a delight to have you on the podcast. And in fact, based on just like your extensive archive of interesting stuff, and you cover a very wide range of topics, You go even much further afield than I do in my writing. I thought we could bounce around a bunch of the stuff that you've written over the last year topically and just kind of hit some of the interesting kind of high points over the last year and things I think will be relevant in 2026. That sound okay?
Sure, sounds great.
Okay, so the first thing I wanted to talk to you about is a piece that you wrote last year on the community banking market in the US. And it was a fun piece to read, actually, because as listeners can probably hear, you are based in the UK, from the UK. And so it was a fun sort of outsider perspective on how strange the US community banking space is. For listeners, just for context, if you don't already know, the U.S. is an aberration compared to pretty much any other developed country in the world as it relates to the structure of our banking market. We have way more banks than anyone else does, and with a very, very long tail of small little community banks, which sort of manifests in us having more banks per capita, again, than almost any other market you could choose to name: Australia, the UK, Canada, what have you. Marc, one of the things I really enjoy about a lot of your writing is that you delve pretty deep into kind of the historical roots of why certain things are true about the financial services industry. And I was wondering if you could kind of summarize, again, from your perspective, like, why do we have so many banks in the US? Why so many community banks?
Path dependence is important. A lot of the reasons why we behave the way we do today and we utilize the institutions that serve us today in the way we do is because of path dependence. And I often stand aside and think about some of the notions that come out of Silicon Valley about, if we had a blank sheet of paper, is this the way we would do this? And the answer would be no, as being somewhat naive, because we've grown and evolved to do things the way we do them. And they may not be efficient. There are, in many cases, positive externalities to them, but it is the way we have grown to do them. And there are certain processes in place that make it very difficult once we've established those norms to do things in a different way. So putting that out there, it is what it is. And I'm not suggesting that we should tear up the playbook in the US and recreate a Canadian style banking system, which regulators, by the way, would love.
Oh, I mean, it's a much, and there's a great book, Fragile by Design. I don't know if you've had a chance to read it, but it delves into a lot of the sort of why behind that and the kind of path dependencies that different markets take over time. And to your point, fewer larger banks that have sort of, let's say, a closer relationship to regulators end up being much safer and more stable. The trade-off, and maybe this can kind of go back to the specific question around community banking and what value, if any, it serves uniquely in the US market, is arguably you have less competition, less innovation, less sort of like dynamism, but it comes with the trade-off of a lot more stability. So like when you apply that lens to our unique community banking situation in the US, what do you say?
Yeah, there was a piece I wrote a few years ago. I've been writing net interest for just over 5 years now. There was a piece I wrote maybe 21, 22. I called it the policy triangle. And it's a kind of riff on the trilemma argument in economics that you can optimize to 2 of 3 things, but not all 3. And in finance, they are competition, they are financial stability, they are privacy, security. And different countries, different regimes, different sets of regulators have taken a view on which of those to optimize. And that process has also changed over time. So, for example, during the financial crisis in 2008, 2 of the UK's largest banks were forced into a merger.
Yeah.
The competition authorities said, no, we're not going to approve this. And under normal circumstances, that would have been the last word. But they were overruled by higher authorities and the merger was waved through. In the US has taken a different view, and there is some history here, actually. To your point about competition versus stability, FDR, I came up with this when looking through the history books to really understand what is the reason why we have so many banks in the US. Back in the early 1930s, before federal deposit insurance had been introduced, there was an alternative proposal to incentivize consolidation. And FDR actually was in favor. But lots of voices, lots of lobbying efforts, lots of vested interests at regional community, we can talk about that as well, regional community bank levels, at the state levels, said no. And actually, deposit insurance was introduced as an alternative. It has various merits today, various drawbacks as well in the way it's currently constructed, but it was proposed as a mechanism almost to support the status quo, which was lots of banks and lots of competition within those banks. And from a consumer perspective, that's great. So now the consumer has a certain degree of protection, but at the same time has the ability to benefit from all the upside that competition introduces to any market. The downside from the regulator's perspective is there's a cost associated with supervising that many banks. And one of the features of banking historically is that competition can lead to short-term behaviors, which aren't necessarily positive when it comes to financial stability. And the great quote there is the Citibank Chuck Prince quote, again in 2008, when the music is playing, we've all got to dance.
Yes. Well, it's interesting the way you describe that, because I mean the history there is fascinating regarding like do we want to have a more consolidated market, or do we want to sort of artificially create mechanisms to protect this market structure that we have? And in the piece you wrote, the most recent piece you wrote on this, you sort of like poke at like this kind of "It's a Wonderful Life" ethos that is sort of like taken root around community banks. And that really is true, right? Like you talk to community banks, or you talk to people who sort of have like a policy view on community banks, and their view of it is just very like, oh, well, it wouldn't be America if we didn't have all these community banks. And it's like, well, wouldn't it? But they like, it's very built into the sort of DNA of just how we think about the market and like what sort of uniquely defines America, which is it's strange even for policymakers, right? Normally policymakers are more like data driven and like, let's look at, this, and we'll kind of make quantitative decisions. And when it relates to community banks, they take that hat off and they put this other, hat on that doesn't in any way correlate to any other like decision-making area within their portfolio. It's very strange.
Yeah, no, absolutely. It's part of the fabric. And as an outsider, I can see that. It's part of the fabric, like home ownership, which we'll talk about, like freedom of speech. There are various features that are considered just inherently American.
Yeah, and community banks is one of them.
Right, yes. And for any lobbyist getting onto that list is the absolute pinnacle, and community banks have done it. I wrote this piece in the aftermath of a conference that was convened in Washington to discuss community banking. Yeah. And literally everybody on the podium, whether they were a regulator, whether they were a big banker, like Jamie Dimon wasn't there, but he's previously talked about how important community banks are to the US, because it would be sacrilegious to say otherwise.
even though his very existence and the existence of Chase is sort of antithetical to the existence of community banks. And it's interesting actually, because two things I'll point out that I was reminded of reading your piece. One was something that I kind of knew theoretically, but had never seen numbers on. Community banks may have sort of grown out of like, you kind of trace it to like, the dual banking system we have, and the fact that states can charter banks, and banks contribute revenue to states through assessment fees and stuff. So like the roots of it all kind of stretch back, but the maintenance of community banking's role in the US and community banking's existence in the US is very much also, like, as you said, a huge lobbying success story. I didn't really realize reading your piece just how much community banks contribute to political candidates, right? Like there was a great stat that you had in there that I think was research actually done by Byrne Hobart. That was saying that the 10 largest banks represent 58% of total banking assets, and they only accounted for 44% of banking industry political donations in 2023, which is wild, right? And another one that was in there was 99 members of that Congress, that session of Congress, counted small banks among their top 25 donors without any big banks on the list, compared to just 66 who have a top 10 bank, but no smaller ones. So like, it's one of those things where, individually, none of them have all that much power, but much like there's a couple other examples in the US, like car dealerships, weirdly, are like strangely, bizarrely powerful in the US, but like there's these community institutions that have figured out a way to kind of knit their political influence together. And truly, as much as when you talk to policymakers, they will talk about community banking in kind of apple pie America sort of emotional terms, that is sort of like a veneer to a degree over top of a deep well of fear about pissing off community banks as a lobby too. So it's a really fascinating dynamic that, again, sounds like is very unique to America.
Yeah, and it kind of conflicts with the way technology is going, which is more centralization, larger
That's what I wanted to talk
scale, network effects. At that event in Washington, Scott Bessent, Treasury Secretary, spoke very positively about the impact that community banks have on the community. But then at the very end, almost paradoxically, talked about the survivors being those that are able to embrace technology. And technology is expensive, right? And one of the things that JP Morgan talks about is their technology budget, which is just so much bigger than I mean, I don't know how it compares to the community banks combined, but
yeah, I mean, it probably is more, right? I mean, we're talking like tens of billions of dollars a year spent on technology, and community banks as a group probably don't spend that amount on technology. And it's interesting. The other thing I wanted to ask you about in the piece that you wrote was you definitely tied it to like, okay, so banking is evolving. And, there actually was, I think, a really strong pressure for a very long time, kind of bubbling up from the States to sort of keep the banking market kind of fractured and like not competitive, right? And so, like, artificially sort of constraining competitive dynamics so that community bank based in Des Moines, Iowa, couldn't be competed with a much smarter bank based in San Francisco, California. And you sort of pinpointed. I've come to think of 1994 as like the year everything changed in banking on a lot of different levels. But one of the things that changed in '94 was interstate banking, and that does seem very much like an inflection point. There's actually a great graph in your piece that sort of shows the pace of consolidation in banking, or the number of commercial banks. And you look at where 94 is, that's really where the line starts to go down in a pretty precipitous way. And it kind of speaks to your point about like, that's the moment when scale and the ability to like build sort of like operational efficiencies, whether it's service oriented or distribution oriented or product oriented, or even from a compliance perspective, like any of those costs, if you could spread them out across a large enough base, you just create a competitive advantage for yourself that's really hard for smaller players to compete with. And even though we still have 4,500 community banks in the U.S., you have some great stats in your piece as well about like the market values them very differently than it values a Chase or these other banks that have sort of reached that escape velocity from a scale perspective.
Yeah. So 94, the peak was 15,000. So we've been on a one-way trend since 1994. Consolidation, there have been some bank failures as well along the way, but consolidation is the overriding factor driving that number down. And that will continue. Mm-hmm. So I think it is inevitable that we will see fewer banks in the US going forward. What the optimal level is, I don't know. But we will see fewer banks, and and we've seen already actually some M&A over 2025, which is likely to continue into 2026.
Yeah. Well, and it's interesting too, because the kind of dueling dynamics that we saw in 2025, and I think we will see this year, one of them, as you said, is like more M&A activity. And I think there was kind of a backlog of like, everyone kind of had their ideal marriages all sort of figured out, but they knew regulators either wouldn't approve them or would just drag it out so long that it was like not worth doing at the time. So I think we're kind of clearing out that backlog a little bit, but clearly regulators have, signaled we're going to be much more open to M&A than the previous administration was. But that is paired with, and maybe I can get your quick take on this, that is paired with also, it's much easier to get a bank charter now than it was before. And yes. I will admit, Mark, to being, I don't know if you've written about this, but I've been a little bit surprised the degree to which like regulators threw the door open to, hey, come apply for a bank charter. If you want an ILC, the FDIC is cool with it. If you want a national bank charter, the OCC would love to talk to you. Oh, you want this obscure national trust bank charter for the specific things you're trying to do in the crypto stablecoin space? Great. We'd love to talk about that. Like it's just wide open. But regulators can make things available, and that doesn't necessarily mean the market is going to like rush towards it. What do you make of the like uptake that industry has had for like, oh, well, we'll take a bank charter? Do you think that's going to continue? Do you think there was also just kind of a backlog of people waiting for that? What's the deal with that?
Yes, I think it will. I think the model through which charters were borrowed. Were through the kind of the arbitrage through which an entity didn't have to be a bank, didn't have a charter, but could utilize a third-party charter, has shown that it is flawed. Various issues that you've covered have emerged out of that. I think the idea that you don't need to be a bank at all was actually survived in the period of low interest rates, but pre-2022.
Yeah.
But post 2022, when interest rates have come off the floor, the benefit to being a bank has increased. And we've seen the same. I mean, it's not just a US phenomenon. So in the UK, what the biggest non-bank right now is Revolut, which is looking to expand globally. They have a license in the European Union, but not in the UK. And they've been on the blotter to receive a authorization for a license for over a year now.
There's been a bit of a wait.
Right. But they're desperate for it. They want it. They're desperate for it. I remember covering the story, as I say, pre-2022, the view at the time was bank valuations we talked about them before in the context of community banks, but even large cap bank valuations are materially lower than tech company valuations. And they didn't. And so why would they want to be classified as a bank?
That was the era of we're not a bank, we're a software company.
Right,
was
precisely.
The
Precisely.
Yeah.
But so I think absolutely more bank charters will be sought out by non-banks.
Yeah, that's interesting. I mean, I guess it all does sort of work backwards from like how we think the market will value A versus B. And I am always kind of fascinated by the companies that sort of swim against the grain a little bit. Chime has always kind of fascinated me in that respect, because even now, like, they don't seem to evince any interest in getting a bank charter, even though I think in a lot of ways it would be a very positive development for their business. But like, they view themselves, I mean, they really do seem to view themselves as a software business or a transactional payment business, not a bank, which is, it's always interesting when someone kind of takes the opposite bet that the rest of the market is taking. Marc, you mentioned a couple things that I want to use to segue to the next topic, which is mortgage. One is interest rate changes. And the other is when you were describing the FDIC and the creation of the FDIC as like, in some senses, an artificially created mechanism to enable like a social or policy goal that's sort of separate from the sort of market structure questions. That perfectly describes the 30-year mortgage in the US, which you've written some great stuff on over the years. That it is absolutely anomalous. It's probably one of the greatest forms of like financial engineering ever in terms of like manufacturing a highly liquid, incredibly valuable market for an asset that, just on its face is ridiculous and no lender should ever want to originate or hold. So we've manufactured this entire sort of ecosystem that is very, very rate sensitive. And, you wrote a piece in November of last year, which was interesting because it painted I would say, less than optimistic picture of the mortgage market at the time, which is probably fairly similar to where we are now. Again, because the mortgage market is so cyclical, anyone who spent any time in that market or around that market or studying that market knows, like, when times are good, you're just like blowing the doors out. You're hiring as many people as you can get. If you're Rocket Mortgage, you're pouring a ton of money into technology and sort of furthering the lead that you have there. You actually use Rocket as an example in the piece of a company that, when interest rates dropped down to nothing and everyone was refinancing, they were just like raking in just huge piles of cash. But the market always eventually flips from an interest rate perspective. And, now as interest rates have gone up, it's really interesting because, again, this kind of ties to the unique nature of the US market, but like a lot of mortgage origination is pretty like fragmented still. And there's these little shops that sort of can kind of survive. And I've always thought of them as like, when times are good, they go hire everyone and their cousin to help out. And then when times are bad, they let all those people go and they sort of hibernate until rates change again. And then they sort of come back to life. But what's interesting is, especially in the non-bank mortgage origination space, which is really sort of expanded and kind of taken over the market post the great financial crisis, there is no like easy way to hibernate if you're someone like Rocket, right? Like, that's like not available to them really as an option the same way. They can focus on cutting costs, but like they have to have a different answer. Can you kind of talk through like how they've had to adjust their strategy or their model to account for like, we've been really successful at origination, but the cyclical nature of this market is kind of killing us now. Like, what have they been doing?
Well, they've done two deals. They bought two companies that are not directly in the mortgage origination space, but broadly are related to home buying and mortgages. One of them was a mortgage servicing business. And historically, servicing was seen as the counterweight to origination.
Right.
The big companies that, like Countrywide, which prior to 2008 was the largest independent mortgage originator in the US, also ran a servicing portfolio and spoke about it representing a natural hedge to the business because the value of servicing goes up when interest rates go down, which is the point, as you've suggested, at which origination flows decline. So they've done that. So it's kind of like a Back to the Future type of transaction. This is a particularly novel insight, but that had historically been a move to specialize, which they're now backpedaling on. And they also bought a realtor company. They also bought an agency on the basis that historically referrals would come from kind of top of the funnel was through home buying agents. And if they were able to capture that top of the funnel, that would be of benefit to them. And actually that's true on the purchase side. The interesting thing about servicing is that it's top of the funnel on the refi side because you have the relationship with the existing mortgage borrower. And so by controlling top of the funnel on both sides, that would be positive, accretive to their ultimate business. That was the decision they've made. What's interesting, coming back to the broader historical point, is that for as long as the 30-year mortgage has been available and for as long as the infrastructure that you described has been present to support it, interest rates have broadly been going down. Any kind of long-term, there were clearly pockets where interest rates spiked in the 80s, for example, before they came down again. But the trend historically has been down. Now, once you hit zero, that's not going down anymore.
Nowhere to go.
And we've seen that. So there's a big question, I think, outstanding around how and the transfer of wealth to homeowners through that process was ongoing. Every time interest rates came down, homeowners were handed an opportunity to refinance if they met certain criteria. Back in when interest rates troughed kind of post-COVID, beginning of the decade, I think there were 17 million mortgage borrowers in the US that were eligible to refinance at a lower cost. That number now is 10% of that, potentially even lower. So the pool of available candidates to refinance is lower. And as long as interest rates aren't structurally going down anymore, that's going to be difficult to replicate. So I think hence, I don't think we're going to go into this, but there is a big generational debate in the US and elsewhere right now. And this is kind of another way that manifests, that you've seen this, those generations that were able to benefit from that transfer of wealth through the decline of interest rates benefited hugely, and now it's done.
This episode is brought to you by Plaid. Approving more borrowers shouldn't mean blindly taking on more risk or adding more friction. The problem is that traditional credit data is limited, and cash flow data alone doesn't always tell the whole story. Plaid helps lenders see the full picture by combining real-time cash flow data with insights from the financial tools people already use every day. Those signals come back in seconds through a low-friction experience trusted by about half of US adults. That means you can approve borrowers who are stronger than their credit file suggests, spot risk earlier, and grow without loosening your standards. Learn more at plaid.com/FTT. Yeah, it's a great point, right? Because you and I were joking before we started recording about politics kind of merging its way into financial services and forcing us to like cover it more in our newsletters. And I think, you can't really divorce, and the piece you wrote last year on this kind of pointed directly at this, you can't really divorce this conversation from that generational discussion, from the broader discussion around like affordability. And it's been interesting, right? Because there's different ways of looking at it, right? You had I think it was a quote in the piece, maybe from Jamie Dimon, who was talking about the market kind of post the great financial crisis, and just sort of saying that like, look, there's a lot more ways to say yes to borrowers that we're sort of not allowed to do, or that are not easy based on the regulations that we put in place after the great financial crisis, which obviously was precipitated by a meltdown in the mortgage market. And I think even in his quote, he sort of acknowledged like, I know why this exists and where this came from, but like, at some point we might have to like kind of take another look at some of those restrictions. So one way of thinking about it is like, can we go a little bit more risk on in mortgage? That's like a very terrifying phrase for me, because I still have very vivid memories of that time. But like, that's one way of thinking about it. We also have, I don't know how closely you follow him on Twitter, but my favorite character in the second Trump administration by far is FHFA Director Bill Pulte, who just sort of like basically like grabs a poster board and like sneaks into the Oval Office, and then crazy shit happens like 24 hours later. It's pretty wild to watch. He, in his sort of aggressive and chaotic style, has if I was to try to stitch together like reason behind what he's doing, seems very focused on kind of making home ownership more affordable. And he's done a bunch of stuff, right? He sort of accelerated the end of FICO's monopoly in the mortgage credit score business to drive more competition into kind of loan underwriting and pricing. He briefly kind of convinced President Trump to float the idea of a 50-year mortgage, which generated a lot of interesting discussion in the industry, a lot of which could have benefited from some very basic kind of math as a part of that. He has more recently, I think, backed away from the 50-year mortgage idea, but has sort of instead sort of advanced the notion that maybe we should restrict large institutional investors from buying up single-family homes. He has a whole bunch of things that he wants to press on as levers with Fannie and Freddie, which obviously the FHFA regulates. I guess I'm curious, Marc, like when you think about this kind of link between the mortgage market and this kind of larger affordability problem, do any of these potential solutions resonate with you? Do you think like they're completely ignoring sort of the essential structural reasons for why this is happening? Like how do you diagnose the connection between those two?
Well, so credit availability is important, and there's no doubt that it is more constrained now than it was, and more constrained than it ought to be economically. And I would have thought, with 20 years on now from peak home building and the loosest credit availability we'd seen in the prior cycle, 20 years on, I would have thought things would have loosened up again by now, but they haven't, because they've been embedded in law. So various laws have been enacted over the past 20 years, which make it difficult and frustrating for banks who would like to do more lending. They'd like to portfolio more mortgage assets, but they're unable to do that. And there are various indicators of that. I think in the piece you're talking about, I show one chart from the Urban Institute, which kind of looks at the inherent default risk in a mortgage. And this is, this is quite topical now in the context of credit cards. We're talking in a week where there's a debate about putting a cap on credit card interest rates. And it kind of throws into the mix this idea that actually, risk has to be priced.
And if you restrict the ability to price risk, you eliminate some of the availability of credit. That's just the natural consequence.
Exactly. And that's what we've seen in housing. We've restricted the way. And so now loan to values are a lot lower than they need to be at the various restrictions. Credit availability is a piece of it, but, and I'm less of an expert on the supply side, but a lot has been written about home building and the number of homes. And it's a feature, actually, it was a big issue it's an issue in the UK as well, that the government here, which has been in power for 15 months, wanted to change. Very, very difficult thing to change.
Yeah.
But yeah, home availability is also key.
Yeah, well, it's a great point, right? And I think that it kind of goes back to that idea, and it's a really fascinating idea, actually, that like generationally there can be these pretty like long periods of history where just a certain group at a certain time in their life can benefit from sort of a larger policy choice, which we may or may not totally consciously recognize that we're making. And it just ends up being incredibly beneficial to one group. And I think like in the same way that, as you said, interest rates kind of structurally going down just afforded all of these kind of continual refinancing opportunities and the ability to kind of add more equity over time. I think that same idea of, and Thompson and Klein talk about this in abundance, but like the embedding of like building codes and restrictions at a very local, decentralized level everywhere across the country, making home building just really, really difficult. Like that was another structural factor that really benefited. Well, if you already owned a home, then like you can expect more appreciation and you can expect a frothier market. So lots of interesting kind of interconnected policy choices. Marc, I want to completely switch gears. I don't even have a good transition here, right. But I guess the easiest thing I could say is going through your archive. The other thing you wrote about in November, besides mortgages that I wanted to ask you about, was agentic commerce. And I think you wrote about it in the context perhaps of Black Friday, which is always a fun, like, payment companies get all stressed out before Black Friday and they're like, wow, you seem pretty tense. And they're like, no, it's fine. And then you talk to them after and they like breathe a sigh of relief and they show you all the great numbers about look what all these things happened and what a great day it was for us. And true to form, Amazon did that, Stripe did that, Shopify did that. But the distinction this year, as opposed to previous years, was agentic commerce was a very big part of the sort of post Black Friday, post Thanksgiving conversation. And I was very curious to just get your take on some of the ideas you shared in your piece, one of which was the sizing of the market. So you had some stats in there. One was from, I think, McKinsey that estimated that by 2030, the U.S. business to consumer retail market could see up to $1 trillion in orchestrated revenue from agentic commerce. And globally, that could be anywhere from 3 to 5 trillion by 2030. And Adyen puts the number in a similar zone, about $2.3 trillion. That's a very big number. And it puts me in mind of, I guess, other like major tectonic shifts we've seen in commerce activity, and particularly in like the sort of front end of commerce activity, like shopping, product discovery. Like this puts me in mind of, 10, 15, 20, 25 years ago when we were talking about e-commerce and like, it's going to be how many trillions of dollars by that date? Like that can't be possible. Or, more recently, like mobile or maybe social, like it seems as though analysts are talking about agentic commerce as, sort of taking the next wave of like, this is going to control distribution. This is going to be the way that people find products. And from what I could tell, it sounds like, the Stripes and Shopifys and Amazons of the world were reporting that did indeed happen, not at that level, but it did happen this last Black Friday. Can you kind of give us a little bit of your take on just like, is that a consistent way that with what you view the market? Like, do you see it in a similar kind of bullish light? What do you think about it, this agentic commerce thing?
Did you, or do you know anybody who made a purchase in that manner?
No.
Nor do I. No. So I don't know. I mean, clearly it's early days. I don't know. So there's a fundamental difference between surfacing information through the chat window and being shown adverts via OpenAI or whoever, and outsourcing a purchasing and payments workflow to the chat window.
Yeah.
So I don't know, and I'm not sure that these companies have necessarily differentiated. There's a great Actually, there's a very good podcast between the Cheeky Pint between John Collison. He's talking to Toby at Shopify. Shopify is very bullish about this, the upside for them. And as I've written in that piece, a potential winner if we go down that route, because they are a kind of representative of underlying merchants. So and they're agnostic, and the extent to which that they can boost sales to those merchants is positive to their business and kind of plays into their business model in a way which might not be the case for other competitors, like Adyen, for example, which have taken a slightly different view. And actually, John Collison on the podcast, and this was pre-Black Friday, he talks about, I think it was a tent. I think he was going camping, and it was a very specific. He talks about a very specific product that he wanted to acquire, and this was the absolute optimal way to make that acquisition. Although he didn't clarify whether payments was then integrated.
Right.
So look, for sure, I can see the utility in integrating shopping into that channel. Whether it cannibalizes other e-commerce sources, whether it's incremental, provides incremental sales, I don't know. Those numbers seem very high to me.
Yeah, I feel the same way. I mean, I think it's funny, right? I don't know if you've had other examples of this that you've come across, but I occasionally notice these trends where I kind of think of it as like demand driven versus supply driven, right? And to a degree, like every healthy market is going to have a combination and a push and pull between like, wow, customers really seem to want this, but also like we need to sort of push this and show customers what's possible. So there's always kind of a push and pull to it. But the agentic commerce conversation has struck me as overwhelmingly supply driven so far, in the sense that like a Visa or a Stripe or a PayPal looks at it and like, their eyes are just replaced with dollar signs, and they're like, "Ooh, look at this! This is great," you know. And it kind of ignores, to a degree, questions about, to your point, like what is the utility to someone that you know personally? Like, would they do this? And if so, how many steps in that process would they trust to that, a particular provider? And it's interesting because one of the things that I think significantly differentiates agentic commerce from some of those previous kind of commerce enablement waves that I was describing before is the bottom of the stack is not accessible to everyone, right? Like you don't just go, and you've written some awesome stuff on like the sort of financing of AI labs and foundation models and like all the like investment that's going in that space. Suffice it to say, you don't just like go in and go, I'm going to build a foundation model that's as good as any of the frontier ones that are out today. Like that is a historically aberrational type of CapEx expense that you're looking at to play in that game, which means that kind of at a somewhat fundamental level, the number of providers who are going to be offering these chatbots is relatively small. And I guess the thing I'm curious about with that, and I'll just use OpenAI as an example, because I know you've studied them a little bit, but like OpenAI is going to control a large part of however big this market becomes, just based on the lead they have in user acquisition for ChatGPT and the fact that they're one of the 4 companies that makes these foundation models. It's not clear to me like how they think about agentic commerce. Like clearly they're interested in it. Clearly they are experimenting with it. They're working with the Stripes of the world and others to like enable it and to sort of see how it's going to work. But like going back to a point you made earlier, they don't do advertising. They have, they have 800 million users worldwide. Like that's one hell of an ad business just sitting there, but they won't turn it on. I've seen public comments from Sam Altman kind of saying that he doesn't really like ads, it seems, kind of philosophically. And it's really interesting to me because, like, going to your point about Shopify, if OpenAI, just theoretically, let's say, was to sort of hold the line and say, we want this to be a chatbot for the end users who use this service. We want it to be totally unbiased. And we think ads would sort of like degrade that experience. Like we looked at Google, great business model, but we think that over time, their ad business kind of destroyed their organic search product. And like that just sort of happens over time. And we don't want to do that. We think we have an opportunity to do something different. That would be extraordinarily bad, I think, for very large merchants who are used to kind of like muscling all the smaller ones out of the way and using sort of their brand and stuff to capture like first party traffic from consumers. But it would be very good for like the Shopify style merchants where it's like, if you make the very best carabiner for mountaineering, or the best tent, or the best hiking boots, or whatever, this is now a new thing, a new like form of product discovery that can be used to like help people find your product. Wow, this is amazing. But there's an alternate and very plausible version of the future in which OpenAI turns on ads, and when they turn on ads, suddenly all those small Shopify merchants can't afford to really advertise and play the same game that large merchants like an REI can. So I guess the question I'm kind of poking at is how much of how like agentic commerce plays itself out is in the hands of, I guess, companies we would consider in the fintech space, like a Stripe or a Visa, or even someone like a Shopify or an Amazon, and how much of it is in the hands of Google, OpenAI, the AI labs. How do you think about that?
It's an interesting point because we have seen a convergence anyway. Through buy now, pay later is a great example, of convergence between traditional commerce and payments. Mm-hmm. Shopify is a payments company. I consider Shopify a payments company. It didn't start out to be a payments company, but it has evolved into one because that is ultimately where the value creation is, and the value, and that's where the margin is. Yeah. So I suspect the same thing. I think, so could OpenAI turn into a payments company? Probably not. But look, right now and I'm not a professional observer of OpenAI, but from what I understand, speaking to those who are, and from what I can see in the market, is they are trying everything. They unlike Google and other established competitors or incumbent competitors, they are looking for revenue streams. Yeah. And so ads could be one. Payments could be another, and they are experimenting with all of the above. There's kind of a third piece. You spoke about supply side and demand side. Yeah. There's a third piece, which is the influence from investors in order to either justify a valuation or to support a valuation. Yeah. And so OpenAI, it will try a number of different approaches, but equally, when we come to, so I watched the Adyen Investor Day, and there was a whole segment on agentic commerce. And coming back to what we were saying earlier, so it could be driven by the consumer, it could be driven by the company, but it kind of occurred to me, in this case, maybe it's also driven by the shareholder or the investor, because every company has to have an AI strategy. Yes. And if you're, a company that doesn't inherently have touch AI, you will either talk about it as a cost-cutting efficiency benefit, like Klarna did, or you'll talk about agentic commerce. Mm-hmm. And if you do a search of mentions of agentic commerce on earnings calls over the course of the past 24 months, it did spike. It spiked on the third quarter earnings calls and into the investor days, like the ones Adyen. But if you go back historically, Visa is a great example of this. Visa will run skunkworks on any potential, and they have the cash flow the same way that Amazon does, the same way that Google does. They've got the cash flow to fund it and to try new things. Around stablecoins, around agentic commerce, around other kind of crypto projects, everything.
Well, and that's a great segue to the last thing I wanted to ask you about before I let you go, which is the other thing you have to have a strategy for these days, Mark, is stablecoins. You have to have a stablecoin strategy. And you have also written a number of times about stablecoins and about sort of the broader, sort of financial servicesization, if that can be a very badly used word, of what's happening in crypto, right? So sort of taking the building blocks of what has been existing in crypto for a long time and sort of porting them over to the non-crypto economy, to the financial services industry, and sort of finding ways to make them usable. Stablecoins are obviously the one that's sort of found product market fit in that sense, I would say the fastest. What is your overall thesis about what might drive the adoption of stablecoins outside of that on-chain economy where stablecoins have existed for a long time?
Yeah, I think so. I think if you talk to Circle or any of the stablecoin companies, they will talk. The number of use cases. So remittances is one, whether that's international or domestic. Whole list of use cases, and they're all credible. I think, to me, the aha moment was when the utilization rates of stablecoins divorced from crypto trading volumes.
Yeah.
And as soon as that happened, it was a realization, to me at least, that actually there's something real going on, because one of the use cases had been onboarding for crypto trading.
Sure.
And when we saw that diminish in the overall share of use cases, that was fundamentally, I think, a bullish indicator for future take-up of stablecoins. I mean, JP Morgan's a good example. JP Morgan is now very well resourced in stablecoin adoption internally. And I heard there was like 250 people working internally globally on various stablecoin projects. I can see the upside. I think we've already transitioned from closed permissioned networks to permissionless.
Well, and the interesting thing about that phrase you just used is there's also like a spectrum there, right? Because like Chase is a good example of this. They have for a while actually been one of the bigger players in using blockchain for B2B payments and commercial treasury and some like very kind of specific use cases. But the way that they implement it would not make someone who sort of believes in this sort of like punk rock ethos of like crypto very happy, because it's really not decentralized at all, right? Like it's a relatively small set of very controlled nodes in a network, and it uses blockchain because the technology is better for certain use cases from an immediacy perspective or from a sort of visibility and kind of shared ledger perspective. But like fundamentally, it's kind of just a different version of a database for Chase to use for certain segments of its business. And it rhymes a little bit also with the development, and you wrote a different piece about this that I thought was awesome about your titles. I'm jealous of, by the way, in your newsletter. I think it was Ready Layer One, which I was like, damn, I was
very proud of that. I was really proud of that one.
that one, and Karma Chameleon or the Klarna Chameleon are the two where I'm just like, fuck, that makes me mad on a professional level. So well done there, but. On the L1s, you're also seeing this as kind of the complement to the stablecoin growth, which is this idea of like, well, we have Ethereum, we have Bitcoin, we have L2s that sit on top of those, but they have like their flaws. What if we built our own proprietary L1 for payments or for some of these other financial services or sort of very stablecoin heavy use cases? And, it just kind of like, I guess gets to this idea that, there's a spectrum between Bitcoin being completely punk rock, original Satoshi sort of mindset, everything is completely decentralized and utterly trustless, to the other end of the spectrum where you have banks doing, tokenized deposit products where it's really not in any meaningful sense decentralized, but it's slightly more compatible with like blockchain technology. Do you have a sense of like where activity or investment might kind of shake out across that continuum? Do you think it's going to be everywhere, or do you see it kind of converging in any one particular place?
Yeah, so I think I was always, I guess having grown up in traditional finance, I do have a certain bias. But
you believe in centralization, Marc? It's okay to say
a little bit. I believe in centralization, Alex. I think the consumer experience is a lot better. And I think the history of finance, and I think the recent history of crypto adoption, also Coinbase and so on, also demonstrates that. So Coinbase had to lead, and banks will follow, but they they have an obligation, a legal obligation to protect their customers. So I think yes. So I think point one, yes, we will see centralization, but I think it's also important to have interoperability.
Yeah.
So I'm not sure there's that much upside versus a standardized deposit to having a tokenized deposit, which isn't interoperable. Now, right now, there's a lot of competition.
Yeah.
Clearly, kind of Ethereum has already established significant market share.
Yeah.
As a network, but it wasn't built with finance applications in mind.
Right.
Hence now the rush to develop, as you said, kind of payment specific rails in crypto. And it'll be interesting to see which ones win out. Probably it'll require the support of a very deep pocketed sponsor with a sizable market share, like Stripe, for example. And we've seen that elsewhere, right across finance. We've seen typically, I also look at exchanges.
Yeah, sure.
And exchange venues have always initially, often through equity participation, got their customers to support their growth. And so the same thing I think will happen here. So, whoever Stripe, JP Morgan ultimately sponsor, probably like to be the winners, but interoperability is really important.
Yeah, it's a great point. And it also, you mentioned this in your piece, but it reminds me a little bit of, the whole, you want to, invest in and get like network effects and get scale and get liquidity. And that tends to sort of define who wins, because these are winner take most kind of markets for the most part. But I think, the counterexample that you also had in your piece was, Facebook tried this a long time ago, this exact thing with Libra, and they were too early and probably too aggressive and globally minded and sort of scary from a political and regulatory target perspective. And so there is this kind of delicate dance, both from a timing perspective and sort of chess moves in terms of how you scale slowly without scaring anyone until it's sort of too late and are just naturally in a position to win in that market.
Yeah, there's a great trading adage, being early is the same as being wrong.
That's right.
And I think that was absolutely the case with Meta. But you're right as well. They were too aggressive. They were also too aggressive. Yeah. But the market has moved on since then.
Yeah, no, absolutely. And we'll continue to make 2026 and beyond interesting. Marc, I will let you go. This was a ton of fun. I really appreciate it. Promise me you'll come back in the future for another chat?
Absolutely. In fact, I'd love to visit, actually. I'd love to meet up with you at one of the conferences in the US. We'll make that something to target in 2026.
I love it. That's a great resolution. Marc, thank you so much.
Thanks, Alex.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.